Hey everyone, and welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. I am absolutely thrilled you're joining us today because, well, we have a truly intriguing accounting case study to unpack. We're going to be looking at a real-world scenario that completely challenges some of the most fundamental principles of balance sheet presentation. If you're the kind of person who loves dissecting financial statements and getting down to the absolute truth of accounting standards, you are definitely in the right place. So I want to kick things off by challenging your accounting instincts right out of the gate. Here's the question. Can trade receivables ever be classified as non-current? Take a second. Really think about it. Your immediate gut reaction might be just a flat no. Or maybe you're sitting there wondering, is there some obscure loophole or exception I'm forgetting about? It's a foundational question about balance sheet presentation, and it's the exact mystery we are going to solve together today. Before we really get into the weeds, just a bit of quick housekeeping. The issue we're exploring today is actually featured in the 227th edition of the Gap Advisors Task Weekly newsletter. That newsletter is authored by C.A. Manish Siayer, director at Gap Advisors, and it's published on LinkedIn. In fact, to date, a whopping 232 editions of this weekly newsletter have been published. So if you're on LinkedIn, I highly recommend you go subscribe to it for free. Also, keep in mind for our discussion that our reporting period follows the standard Indian financial year. So that's beginning on the 1st of April and ending on the 31st of March. And all the figures we'll talk about are strictly in Indian rupees, not US dollars. Finally, a quick but super important reminder. The views expressed in this explainer are the personal views of the author, and they're not binding. Always seek the help of a qualified expert before taking or refraining from any action based on what we discuss here. All right, let's get into it. Part 1. The symptom, a balance sheet anomaly. Okay, let's dive into this. Every good investigation starts with a symptom, right? A clue that something just isn't quite right. And what we're looking at today isn't some theoretical textbook exercise. This is a real-world observation. It was discovered during a suo moto review of the published Ind AS financial statements of a listed company. Our team at Gap Advisors actually downloaded and independently reviewed these statements, and something immediately jumped off the page. Under the financial assets category, we see item Roman numeral 3, trade receivables, and they are reported at 599,900,734 Indian rupees as of the 31st of March 2020. So basically, they've classified nearly 600 million rupees of trade receivables directly under non-current assets. This right here is our anomaly. Why in the world is a receivable, literally the lifeblood of day-to-day business cash flow, sitting over in the non-current bucket? Which brings us perfectly to part 2, the diagnosis, where we consult Ind AS 1. To figure out if this is actually permitted, let's crack open the official rulebook. Let's read the specific guidance straight from the source. Paragraph 68 of Ind AS 1 explicitly states, current assets include assets such as inventories and trade receivables that are sold, consumed, or realized as part of the normal operating cycle, even when they are not expected to be realized within 12 months after the reporting period. So the absolutely crucial point here is that explicit mention of the normal operating cycle. You see, the standard doesn't just say current assets are things realized within 12 months. It deliberately and specifically ties trade receivables directly to the operating cycle itself, completely regardless of that standard 12-month timeline. To really lock this concept in, let's clarify exactly what the standard means by an operating cycle. It is the time between the acquisition of assets for processing and their realization in cash or cash equivalents. Just think about what a trade receivable actually is. You produce a good, actually scratch that. You produce a good or provide a service, you sell it to a customer on credit, and then eventually you collect the cash. That receivable is the final, critical step in converting your daily business activities back into cold, hard cash. It is inherently, inextricably linked to this timeline. And this brilliantly illustrates the disconnect. When we place the company's presentation side by side with the strict Ind AS 1 requirement, it's night and day. Paragraph 68 clarifies that assets that are part of the operating cycle are always classified as current. Because trade receivables are generated directly from the operating cycle, they belong in the current category. Period. There just isn't any wiggle room here for a non-current classification just because, say, a specific invoice might take an unusually long time to collect. So, it is time for part 3, the final verdict. We've seen the hard evidence from the listed company's balance sheet, and we've analyzed the explicit rules laid out in paragraph 68 of Ind AS 1. It all comes down to this. The verdict? It's definitive noncompliance. Because trade receivables are inherently part of the operating cycle, they simply cannot be classified as non-current. By placing nearly 600 million rupees of trade receivables in the non-current asset bucket, this company has strictly failed to comply with Ind AS 1. And think about the ripple effect. This throws off liquidity ratios, it misrepresents the company's working capital, and it fundamentally misapplies the accounting standard. Moving on to Part 4, Preventative Care and Proactive GAAP Advisors Solutions. Seeing an error like this in a published, listed company's financial statements, it should make any professional pause. If they can miss it, how do you ensure you don't? Well, that massive number you're looking at, over 4,500, represents the incredible issue repository over at gapadvisors.com. That site currently hosts over 4,500 unique issues and their detailed responses regarding Indian accounting standards and Indian GAAP. And honestly, here's the best part. Anyone can register for absolutely free. You can submit issues on Ind AS and Indian GAAP and get detailed, structured responses delivered directly to the inbox of the email you registered with. If you are an auditor who needs to rigorously document exactly how you addressed any issue relating to the application of Ind AS, this database is just an absolute goldmine for you. But why stop at research when you can get direct expert validation? You can actually get your financial statements independently reviewed by GAAP advisors before you sign them. The process is incredibly simple. It's just 3 easy steps. First, get your financial statements into a near-to-publishing PDF format. Second, email that document directly to info@gapadvisors.com. And third, sit back and let GAAP advisors review it before you put your name on the dotted line. It is literally the ultimate peace of mind. Well, that brings us to the end of our explainer. I want to sincerely thank you for your time, your focus, and for geeking out over accounting standards with us today. Before you go, I do want to leave you with a provocative thought. If a foundational metric of working capital, like a trade receivable, can be hiding in plain sight in the wrong section of a listed company's balance sheet, what other classification errors might be lurking in the financial statements you rely on every day? If you found this breakdown valuable, please go ahead and hit that like button, add a comment down below with your thoughts, and make sure you are subscribed to the GAAP Advisors Ind AS Clinic channel if you aren't already. We also strongly request that you share this explainer with your contacts, your colleagues, and especially your audit and finance teams to help us spread the knowledge of Indian accounting standards far and wide. Oh, and don't forget to connect with the GAAP Advisors Ind AS Clinic podcast on Spotify, Amazon, or YouTube for a great audio deep dive into the observation we just dealt with today. Keep learning, keep questioning, and we will see you in the next explainer.